Let's first look at the cash flow coverage ratio. This measures a company's ability to pay long-term debt, otherwise known as solvency. More specifically, it is the amount of cash available to pay the borrower's interest expense. It's useful for banks and creditors to evaluate the risk of repayment, or non-repayment as the case may be. For Lou, it would be good to check this ratio if he were considering taking another loan, as it would help him understand if he were in a good position to pay off his liabilities or not. Let's see how to calculate the cash flow ratio for a business next. This ratio has some variations, but we will stick to the basics. Let's suppose Milligan's Mustache Wax wants a loan for a new manufacturing plant. You know how popular mustache wax is these days. Operations are expanding. Anyway, Milligan's bookkeeper is going to review the company's cash flow statement to see if Milligan's credit is decent and to evaluate the company's ability to repay the loan. The cash flow coverage ratio is one ratio the bookkeeper can look at. To calculate, cash flows from operations is divided by total debt. Milligan's bookkeeper reviews the statement of cash flows and finds last year's operating cash flows totaled $57,000 and total debt payable for the year was $38,000. This means Milligan's ratio is 1.5. This means the company could pay off its debts 1.5 times with operating cash flows, so that's a pretty decent ratio. Essentially, the higher the ratio is, the more cash a company has to pay off debts and have left over after paying debts. While generally a desirable ratio is more than one, a lot of large corporations have much smaller ratios because they can fund their operations through debt. Though for a small business, a ratio less than 1 means there are fewer funds than the amount to pay off all liabilities, which for a small business means it might have to consider a refinancing or restructuring of operations to generate more cash flows. Let's hear a little more about this ratio from an expert.
The cash flow coverage ratio is really helping a company understand if it can pay its interest and principal payments when they become due for the debt that they have. So in other words, can the company pay its debt obligations? So this is obviously important, and there are many times that this is going to come into play as we're looking at ratios for the company. Just keep in mind that this is one of the ways that we measure the health of an organization. And there are times when, as a bank might be looking at something like this, there could be indicators about how solvent it is, how much it's able to have any kind of liquid assets to be able to take care of what it needs to take care of.